July 2025. Public pension funded ratios improved to 82.5%, up from 78.0% in 2024, according to Equitable Institute's State of Pensions Report. Unfunded liabilities declined from $1.54 trillion to $1.27 trillion. Employer contributions and strong investment returns drove the improvement. State and local pension systems appear to be recovering from decades of underfunding. Mainstream coverage celebrates the funded ratio gains. The narrative is straightforward. Pensions are healing, unfunded liabilities are shrinking, the crisis is resolving. Policymakers can reduce focus on pension reform. Taxpayers can expect stability. Here's what the pensions improving narrative misses. The 82.5% funded ratio exists because employer contributions reached 31.65% of payroll, the fourth consecutive year above 30% and more than triple the 9.41% rate from 2001. Between 2001 and 2024, payments toward unfunded liabilities jumped 2,541%. State and local governments are bleeding resources into pension obligations at the expense of infrastructure, education, and public services. More fundamentally, the improvement depends on investment returns that pension systems historically haven't achieved. The average assumed rate of return is 6.87%, but between 2001 and 2023, 99% of public pension funds failed to meet their average assumed returns, achieving 6.5% actual versus 7.59% assumed. That gap, seemingly small at 0.5 to 1 percentage point, compounds over decades into hundreds of billions in additional unfunded liabilities. And the system remains catastrophically vulnerable. A stress test assuming a 20% market downturn projects funded ratios could collapse to 63%, and unfunded liabilities could surge to $2.74 trillion. 3 years of contribution increases would evaporate in one recession. This isn't about whether pensions paid promised benefits this year. This is about recognizing when pension systems operate with assumed returns systematically higher than achievable returns, and understanding what happens when contribution rates exceeding 30% of payroll crowd out essential government services while failing to close funding gaps. By the end, you'll understand why improving funded ratios matter less than unsustainable contribution rates and return assumption gaps. How the four-stage pension funding stress cycle reveals when budget crowding accelerates. What $1.27 trillion underfunding, 82.5% funded ratio, 31.65% contribution rates, and 6.87% assumed returns versus 6.5% actual signal. Why Detroit bankruptcy, Illinois fiscal paralysis, and CalPERS chronic underfunding provide pattern templates. Where today's pension metrics place state and local governments in the funding stress progression, how pension contribution rates exceeding 30% of payroll force service cuts and tax increases, the 7 signals showing stage 3 budget stress despite improving funded ratios, why this hits taxpayers and public employees before any pension payment misses. Let me show you the pattern that repeats every time pension systems assume investment returns they systematically fail to achieve. This isn't about whether pensions paid promised benefits this year. This is about recognizing when pension systems operate with assumed returns systematically higher than achievable returns, and understanding what happens when contribution rates exceeding 30% of payroll crowd out essential government services while failing to close funding gaps. By the end, you'll understand why improving funded ratios matter less than unsustainable contribution rates and return assumption gaps. How the four-stage pension funding stress cycle reveals when budget crowding accelerates. What $127 trillion underfunding, 82.5% funded ratio, 31.65% contribution rates, and 6.87% assumed returns versus 6.5% actual signal. Why Detroit bankruptcy, Illinois fiscal paralysis, and CalPERS chronic underfunding provide pattern templates. Where today's pension metrics place state and local governments in the funding stress progression, how pension contribution rates exceeding 30% of payroll force service cuts and tax increases, the 7 signals showing stage 3 budget stress despite improving funded ratios, why this hits taxpayers and public employees before any pension payment misses. Let me show you the pattern that repeats every time pension systems assume investment returns they systematically fail to achieve. To meet their average assumed returns, achieving 6.5% actual versus 7.59% assumed. That gap, seemingly small at 0.5 to 1 percentage point, compounds over decades into hundreds of billions in additional unfunded liabilities. Stage 1. Funded ratios healthy and contributions modest. Pension systems maintain funded ratios above 90%, meaning assets cover more than 90% of liabilities. Employer contribution rates remain below 15% of payroll. Investment returns meet or exceed assumptions over multi-year periods. Demographics favor the system, more active workers than retirees. Pension costs represent a manageable portion of government budgets. Infrastructure, education, and public services receive adequate funding. No political pressure exists to cut benefits or raise taxes. This describes the pre-2008 environment for most state and local pension systems, when median funded ratios exceeded 100% and contribution rates averaged under 12% of payroll. Stage 2. Unfunded liabilities. Grow and contribution rates rise. A market shock, typically a recession and bear market, causes investment losses. Pension assets fall while liabilities continue growing. The funded ratio drops below 90%, then below 80%. Governments increase contribution rates to 15-25% of payroll to address the gap. Investment return assumptions begin getting reduced as trustees acknowledge that 8% projections aren't realistic, but actual returns continue falling short of even reduced assumptions. Negative cash flows appear. Benefit payments exceed contributions as retirees increase relative to active workers. The unfunded liability grows despite higher contributions because investment underperformance and interest accumulation outpace payments. This characterized 2009-2019 following the financial crisis, when funded ratios fell to 70% nationally and contribution rates doubled from pre-crisis levels. Stage 3, contributions. Exceed 30% payroll and essential services get crowded. Employer contribution rates cross 30% of payroll and continue rising. For every $100 in employee salaries, governments must contribute an additional 30+ to pension funds. This crowds essential services. Infrastructure maintenance gets deferred. Hiring freezes reduce public services. School budgets tighten. The pension tail wags the budget dog. Pension obligations drive resource allocation rather than public needs. Political tension escalates between pension beneficiaries and taxpayers. Unions resist benefit modifications. Taxpayers resist tax increases. Credit rating agencies downgrade state and local bonds, raising borrowing costs. Funded ratios stabilize or improve modestly, but remain far below 100%. The system operates in quasi-equilibrium, painful but not yet breaking. This is where the U.S. public pension system sits today with 31.65% contribution rates and 82.5% funded ratio. Stage 4, benefit cuts, tax increases, or bankruptcy. The breaking point arrives when governments can no longer sustain 30% plus contribution rates without destroying public services, or when a recession causes another funded ratio collapse. 3 paths emerge, none pleasant. Path 1. Benefit cuts for current retirees and active workers, typically requiring constitutional amendments in states with pension protection clauses. Path 2. Major tax increases, politically difficult and economically damaging. Path 3. Municipal bankruptcy, allowing pension restructuring through federal court. Detroit chose bankruptcy. Illinois remains paralyzed between the first 2 options. The outcome always involves wealth transfer, either from future retirees through benefit cuts, from current taxpayers through tax increases, or from current retirees through bankruptcy haircuts. Where are U.S. public pension systems today? Deep Stage 3, approaching Stage 4. Triggers: contribution rates above 30% for 4 consecutive years. Funded ratios improved but vulnerable to recession shock. Return assumptions still exceeding historical performance. Negative cash flows expanding. The question isn't whether the breaking point arrives, but which path governments choose when it does. Detroit's bankruptcy in 2013 provides the template for the most extreme pension resolution mechanism. The city faced approximately $18 billion in debt, with pensions representing the largest component. The city's general employee pension fund was roughly 60% funded, the police and fire fund approximately 70% funded. The bankruptcy process allowed Detroit to restructure pension obligations over creditor objections. General city employees saw pension cuts averaging 4.5%, with cost of living adjustments eliminated. Police and fire retirees faced smaller cuts. The restructuring required state contribution of $350 million and foundation corporate contributions of $366 million to the Detroit Institute of Arts in exchange for protecting the museum's collection from liquidation. The critical lesson: Detroit chose bankruptcy over continuing unsustainable pension contribution rates. The alternative, maintaining pension promises while providing basic city services, had become mathematically impossible. Police response times had degraded, streetlights failed, infrastructure crumbled. The city faced a choice between serving 700,000 current residents or honoring pension promises to 20,000 retirees. Detroit's pension problems originated from decades of assuming 8% investment returns while achieving lower actual returns, granting benefit increases during bull markets that persisted through bear markets, and systemic underfunding of required contributions. By 2013, these factors compounded into insolvency. The bankruptcy option existed only because Detroit is a municipality. States cannot declare bankruptcy under current federal law, forcing them toward benefit cuts or tax increases. Illinois represents the opposite extreme, a state with massive pension underfunding, unable to use bankruptcy, constitutionally prohibited from cutting benefits, and politically unable to raise taxes sufficiently. Illinois holds approximately $142 billion in unfunded pension liabilities, with a funded ratio around 45%, the worst in the nation. The Illinois Constitution contains a pension protection clause prohibiting any reduction in pension benefits. This creates an immovable object. The state cannot cut its way to solvency. It can only contribute or invest its way out. But contribution rates already consume enormous portions of the budget. The state's credit rating has been downgraded to near junk status, raising borrowing costs and further straining finances. Illinois has tried numerous approaches: pension obligation bonds that essentially bet borrowed money on investment returns, exceeding bond interest costs, phased increases in employee contribution rates, reduced benefits for new hires, and temporary tax increases. None have solved the structural problem. The gap between pension assets and liabilities continues growing despite aggressive contribution increases because investment returns, underperform assumptions, and negative cash flows accelerate. The state faces a slow-motion crisis. It hasn't defaulted on pension payments, but it chronically underfunds other services, delays vendor payments, and operates with massive payment backlogs. The pension burden crowds everything else. Education funding, healthcare, infrastructure, all compete for resources after pension obligations. Illinois cannot access bankruptcy protection like Detroit. It must either amend its constitution to allow benefit modifications, politically nearly impossible given union strength, or sustain ever-increasing contribution rates, financed by ever-increasing taxes. The third option is federal bailout, which creates moral hazard and political opposition. Illinois represents the Stage 4 trap. No good options, only painful choices. The California Public Employees Retirement System, known as CalPERS, is the nation's largest public pension fund with approximately $469 billion in assets, covering 2 million members and retirees. Its size and sophistication haven't prevented chronic underperformance relative to return assumptions. Between 2001 and 2023, CalPERS achieved investment returns averaging approximately 1.98 percentage points below its assumed rate of return. This systematic shortfall created tens of billions in additional unfunded liabilities. The pattern is consistent. CalPERS assumes 7% returns, achieves 5 to 6% actual returns after fees and expenses, and the gap compounds over decades. CalPERS reduced its assumed return from 7.5% to 7.4% in recent years, acknowledging market realities. But even this reduced assumption exceeds historical performance. The system's investment strategy shifted dramatically from traditional stocks and bonds into alternative investments, private equity, real estate, infrastructure. These alternatives promise higher returns but involve higher fees, lower liquidity, and greater complexity. The CalPERS experience demonstrates that even well-managed, large, sophisticated pension systems with professional staff and external advisors struggle to achieve assumed returns consistently. If CalPERS underperforms by 2 percentage points annually, smaller systems with fewer resources face even worse odds. The underperformance forces California governments to increase contribution rates. School districts, cities, and counties face pension costs, consuming growing shares of budgets. A teacher earning $70,000 might trigger $25,000 in pension contributions, 35% of salary. Those costs don't fund current education, they fund past promises. The budget squeeze forces larger class sizes, deferred building maintenance, and hiring freezes. The national picture of public pension underfunding crystallized in the 2025 State of Pensions report published by Equitable Institute. Total unfunded liabilities stood at $1.27 trillion as of mid-2025, down from $1.54 trillion in 2024. The funded ratio improved to 82.5% from 78.0%. These improvements occurred for two reasons. Employer contributions, reaching historic highs of 31.65% of payroll, and investment returns of approximately 9.5% in 2025, exceeding the 6.87% assumed rate. The positive performance reversed the 2022 experience when returns averaged 4.8%, demonstrating the volatility inherent in current investment strategies. But the $1.27 trillion unfunded liability represents only the official actuarial number using 6.87% discount rates. If pensions used private sector discount rates based on risk-free treasury yields around 4 or 5%, unfunded liabilities would exceed $3 trillion. The choice of discount rate dramatically affects measured underfunding. Higher assumed returns allow higher discount rates, which reduce measured liabilities, creating circular logic that understates true funding gaps. The composition of unfunded liabilities reveals why the problem persists. According to Equitable's analysis, 35.7% of accumulated unfunded liabilities since 2000 resulted from necessary improvements to actuarial assumptions. systems finally acknowledging that 8% returns weren't achievable. Another 29% came from underperforming investment returns. Interest on existing pension debt accounted for 22.4%. These three factors, overly optimistic assumptions, underperformance, and compounding interest, drive 87% of unfunded liability growth. State pension systems hold $1.29 trillion of the national unfunded liability total, with local governments holding $187 billion. The concentration at the state level reflects that most local governments participate in statewide systems, but some cities and counties operate independent pension funds, and these often face worse underfunding than state systems due to smaller asset bases and fewer resources for professional management. The funded ratio of 82.5% sounds substantial, more than 80 cents on the dollar saved. But pension finance differs from other liabilities. These obligations span decades. A 40-year-old worker might not retire for 25 years and then receive benefits for 30 years, a 55-year timeline. An 18% funding shortfall compounding at 6.7% interest becomes massive over decades. The $27 trillion gap will double to $2.5 trillion in roughly 10 years at 7% interest if not addressed through contributions or investment outperformance. The employer contribution rate trajectory tells the real story. In 2001, state and local governments contributed an average of 9.41% of payroll to pensions. By 2025, that rate reached 31.65%. The increase wasn't primarily driven by expanded benefits. It came from paying down unfunded liabilities accumulated through decades of optimistic assumptions and underperformance. Between 2001 and 2024, dollar payments toward normal cost, the present value of benefits earned in the current year, increased 159%. Payments toward unfunded liabilities increased 2,541%. Governments aren't paying more to provide better pensions. They're paying more to cover past shortfalls. This 31.65% contribution rate represents the fourth consecutive year above 30% of payroll. To contextualize, for every $100,000 in teacher salaries, the school district pays an additional $31,650 to pension funds. That's money not available for classroom supplies, building maintenance, or hiring. When police officer salaries total $50 million, the city pays $15.8 million in pension contributions, enough to hire 200 additional officers at $79,000 each, including benefits. The contribution rate increase happened despite, or because of, reduced return assumptions. As pension boards lowered projected returns from 8% to 7% to 6.87%, required contributions increased. The math is straightforward. Lower expected investment gains require higher cash contributions to reach the same funding level. This creates a painful transition period where contributions spike as assumptions normalize. The fundamental problem is that 99% of public pension funds underperformed their assumed returns between 2001 and 2023. The average fund assumed 7.59% returns during this period, but achieved 6.5%. This 1.09 percentage point gap seems small. Over 23 years on a $100 billion portfolio, the difference between 7.59% and 6.5% returns is approximately $150 billion in lost value. Some funds missed badly. The Arizona Public Safety Personnel Retirement System and Arizona Corrections Officers. Retirement plan underperformed their assumptions by 3.7 percentage points annually over 23 years. Chicago's largest pension funds missed by 2.05 percentage points annually. CalPERS missed by 1.98 percentage points. The median assumed return has fallen from 8.0% in 2005 to 7.0% in 2025. This represents pension trustees slowly accepting market realities. But the gap persists. Current assumptions of 6.87% still exceed the 6.5% historical average performance. Until assumptions equal achievable returns, the system will continue generating unfunded liabilities that require ever higher contributions. The investment strategy shift toward alternative assets exacerbates risk. 20 years ago, public pensions held approximately 64% in equities. By 2025, that allocation fell to 53%. The difference moved into private equity, hedge funds, real estate, and infrastructure. These alternatives promise returns exceeding public markets, but come with higher fees, often 2% annually plus 20% of profits, and illiquidity. Private equity returns depend on investment vintage year. Funds raised in 2006-07 largely failed to beat public markets. Funds raised in 2009-2010 performed exceptionally. Pension systems making steady annual allocations experience average vintage year performance, which after fees often underperforms public equity indexes. Hedge funds have systematically underperformed balanced portfolios after fees. Real estate faces cycles. Strong performance 2010, 2020, negative returns 2022, 2024. The alternative asset allocation creates valuation risk. Public equities are marked to market daily. Private investments are valued quarterly or annually based on appraisals. During market stress, public assets fall immediately while private assets decline with a lag. This creates an illusion of stability. Private portfolios appear less volatile than they actually are. The 2025 State of Pensions report estimates valuation risk at 25% of assets, meaning quarter-end reports may overstate true values by hundreds of billions during market stress. Here are 7 signals to watch through 2026-2027. Signal number 1, employer contribution rates exceed 35% of payroll. At 31.65% now, crossing 35% would signal stage 4 transition, the breaking point where governments cannot sustain pension costs without destroying services. Signal number 2, funded ratio falls below 75% nationally. Currently at 82.5%, a drop to 75% would erase 3 years of improvement and signal recession impact. Signal number 3, negative cash flows exceed 10% of assets annually. Cash flow negative means benefit payments exceed contributions. When this gap exceeds 10% of assets, pension systems must liquidate investments during down markets, locking in losses. Signal number 4, major state implements benefit cuts for current retirees. This would break the taboo against retroactive modifications and signal constitutional protections collapsing under fiscal pressure. Signal number 5, federal legislation enables state bankruptcy. Currently impossible. Federal law change allowing state bankruptcy would signal systemic recognition that some pension obligations cannot be honored. Signal number 6, multiple pension systems reduce assumed returns below 6%. Currently averaging 6.87%, widespread drops to 5.5 to near 6% would trigger massive contribution increases and measured liability explosions. Signal number 7, recession causes funded ratios to drop below stress test projections of 63%. If actual results exceed stress test assumptions, it confirms extreme vulnerability. Next episode, the Social Security Trust Fund depletion, how the Old Age and Survivors Insurance Trust Fund depletes in 2033, 8 years away, requiring either 21% benefit cuts, 25% payroll tax increases, or $22 trillion present value borrowing to maintain promised benefits. The pattern is documented. The sequence is clear. The only question is whether you recognize pension funding stress before contribution rates exceeding 35% of payroll for service cuts, tax increases, or benefit modifications. This isn't about predicting pension default. This is about recognizing when pension systems operate with assumed returns systematically exceeding achievable returns and contribution rates already consuming 31.65% of payroll, and understanding what happens when the next recession tests a system that stress tests show could collapse to 63% funded with $2.74 trillion in unfunded liabilities. The 82.5% funded ratio exists because governments are sacrificing infrastructure, education, and services to make unsustainable pension contributions. The improvement is real but fragile. One bad year erases 3 years of gains. The system works until it doesn't, and when it doesn't, taxpayers and public employees both lose.